Thank you for joining us today. I'm Stephanie Weston, and I'm an analyst in the university's investment office. We have a wide range of registrants joining us for this session, including students, faculty, staff, parents, alumni, and friends. Today's webinar will provide an overview of investment performance and process. Before we begin, I'd like to share a few Zoom webinar tips. If you would like to ask a question, please submit it through the Q&A function that is located at the bottom of the screen. Doug will answer questions at the end of his presentation. In addition, in your registration email for today's webinar, you'll find a link to the 2022 Endowment Update. We hope you've had an opportunity to view that video. A recording of today's session will be made available on the Investment Office website for the audience early next week. I would now like to introduce our next speaker. Naveen Nataraj is a Senior Managing Director of the Corporate Advisory Business at Evercore, a leading global independent investment advisory firm. He founded the technology practice at Evercore and has advised technology and telecommunications clients in transactions exceeding $500 billion in value, including 5 of the 7 largest announced technology transactions to have ever occurred. Before joining Evercore, he was a founding partner at Saturn Venture Partners and a vice president at Sandler Capital. In 2011, Naveen was named one of the Investment Dealers Digest's 40 Under 40 Dealmakers and Fortune Magazine's 40 Under 40 Rising Stars of Business. Naveen graduated from the University of Rochester in 1997 and has served on the university's Board of Trustees since 2019 and as chairman of the board's investment committee since 2020. Naveen and his wife established the Courtney and Naveen Nataraj Endowed Scholarship Fund at the university in 2014. Thank you again for joining us, and I'll now turn it over to Naveen.
Thank you, Stephanie, and thank you all for joining this important update. I'm going to be brief here and introduce Doug Phillips, who is the Chief Investment Officer of our endowment. Doug has been with us for 22 years. I think it's his 22nd year here, and after a 40-year career in investment management. We are, and I can say this at a personal level, I think the university is extraordinarily fortunate to have Doug as a steward of our endowment. We have, as you'll hear, outperformed many of our peer indices over an extended period of time. And it takes a steady hand to manage the endowment through various different environments. And we're in a particularly interesting moment in time as we speak. Doug joined us from Williams College, where he spent 14 years in the investment office. And prior to that was at Princeton. Doug is a graduate from Rutgers and an MBA from RPI, and is highly active on a philanthropical and social level in the community at Rochester. I think Doug's most important achievement in a lot of ways, and I think we all at the committee recognize it, is assembling a world-class team that you'll hear from today. And again, before I turn it over to Doug, I just want to express my sincere appreciation for all his efforts over the many years here at Rochester. Thank you, Doug.
Thank you, Naveen. And what you said about the team is probably the most important thing here. It's a team of great volunteers on the investment committee and really a terrific staff here in the investment office, knowledgeable and collaborative. And we have a brief presentation slide deck that we can put up, and I'll go through that. But it's really been my pleasure to serve here for the past 22 years, and we've achieved the goals that were set forth when I arrived, and we can put those goals up as the first slide. Thought you might want to see those. And by the way, welcome to everybody. We have 140 participants on this call, so obviously this is an area of great interest, the investment environment, and we'll get to that after the quick presentation here. So can we flip to the first slide, Stephanie? So the goals of the program since I arrived were to beat a passive benchmark of stocks and bonds, and we've always had more or less an 80-20 bond or 80-20 stock exposure and a 20% bond exposure. And we know that you cannot invest in regard to being a long-term investor and have that result occur every year. So exceeding it over 5 and 10 year periods is what we thought was appropriate. And we've done that consistently. And then the second one was to look reasonably good among close peer institutions. We have 9 in that group, and those are 5 and 10-year numbers. We'll show you those in a bit. And then obviously we have to meet the spending requirements of the university and grow that spending by at least the inflation component. And inflation's been low, has been benign, but now it's rearing its ugly head. That is going to be a tough one going forward, but we certainly have done that over time. So flip to the next one, please, Stephanie. Here's our results against our peer group, 1, 3, 5, and 10-year results. The idea here is that we should at least be in the upper half. These are non-Ivy private research universities, including one Ivy League school in New York State that's just south of us here in Western New York. But schools like Emory, Johns Hopkins, Case Western, Carnegie Mellon, those types of schools. The reason we have that is their endowments are typically a little smaller than the Ivy Leagues, and they're growing their endowments through philanthropic support as well as investment performance. And our goal here at the University of Rochester is to grow the endowment both through investment performance and philanthropy, and that helps our students and faculty enormously. So let's go to the next one. The 10-year number that you saw on that last slide is brought back for rolling 10-year periods. So looking from the right to the left, you'll see our performance in that same peer group has always been in the top half. And if you look at 2020 and 2021, we look like we're in 4th place, but we also think that the difference between 2nd, 3rd, and 4th is very small, it's essentially the rounding error. So we're still in the very top part of the group. So we've had very consistent, strong 10-year results. Next one. Stephanie, there we go. How we achieve this. There are components of the portfolio that we measure against a survey of large endowments. These are billion-dollar-plus college and university endowments. And we learned from the survey what in aggregate the schools have returned for each category, and then what our return has been in that category. And then we also look at our allocations in the category. And then we marry the two together each year to determine whether or not we've had a positive impact or negative impact. So in other words, if we overweight a category that is not performing well, that'll be a negative influence. Likewise, if we underweight a category that's performing very well, it's a negative influence. Or if the managers that we select, the investment firms that we select to manage don't do as well as the peer group, that's another source of possible underperformance. This past year was an unusual year because we had a unique synergy between allocations and manager performance, where most of the categories produced a positive result. In typical years, we get 4 or 5 categories. And this year we had 4 or 5 positive categories. This year we had 5 very positive categories, 2 that were more or less neutral, and 1 slightly negative in real estate, as you can see, but really not by very much. But when you roll those together, the average educational endowment over $1 billion returned 37% for the year, and we returned 41.7%. And that's net of all the fees that are paid to the managers and all the administrative costs and that sort of thing. And I'll take questions on this chart or any other chart at the end. So this is a little more detail on the sources of return and where we were on the average weights for the year. It's essentially the same data as you saw on the past slide. It's just ranked by the contribution to return. So venture capital and our private company program, private equity, were the big contributors to return, as was the hedge fund program. And our opportunistic category, those are public equity, public stock managers that are active. And they had actually very, very good return against the benchmarks this past year. All right, Stephanie. Summary of the allocations at the end of the calendar year. Public equity remains one of the largest categories. There is some volatility there, as you've seen in the past 5 months. And we know that volatility comes. That's why we have the rest of the portfolio in highly diversified categories. Those 3 pie slices on the left, lower left, are all called alternative investments because they don't correlate necessarily to the public stock market. So we have about 62% of the portfolio in investments that have little or no correlation to public stock market performance. Next page. This is another category of measurement that many people are interested in. Where do we have the weight of the portfolio, US versus non-US? And when we look at the long-term investment pool, by the way, is called the LTIP. It's mostly the endowment, but it's some other monies from the university. The LTIP, if you look at that left chart, it's about 87%. That's because part of the LTIP has short exposure. So this is a net exposure. Short means that it has essentially protective allocations that don't correlate with stocks, or they may inversely correlate with stocks. So we think it's best to measure our net exposure. The yellow bar going across is the emerging markets exposure. And those of you that follow stocks know that the emerging economies of the world are very large. And when you look at the emerging countries' stock markets, they're actually quite small. So compared to the rest of the developed world. So our benchmark, if you look at just the stocks, the benchmark would have us at an 11% weight to emerging markets. We're actually 27% weight to emerging markets. When we take the benchmarks, the stock benchmarks, and we weight them differently, we look at them as the size of the economies. So we're taking the companies and making them larger based on the size of their economies to represent the universe of investable things. Then we have a 35% weight in the benchmark, and we're somewhere between the unweighted GDP benchmark and the GDP weighted benchmark. So the 27% is right in the middle. And that's so, but it's important to know that our emerging markets exposure has been relatively high for the past decade, and it will stay there. Next slide, please. This is a slide showing the protection of the portfolio. I was mentioning earlier that we have a lot of things that don't correlate to stocks. The rising markets are shown obviously above the line. We typically don't keep up in rising markets, but we do perform much better when the lines are below that horizontal bar. Those are declining markets. And interestingly, we almost kept up with the post-COVID, right after the depths of the stock market crash during COVID. We've earned 53% in the 18 months or so since then, or 19 months, I think it is. And the benchmark is 58%. So that was a very good return in a very short period of time. Okay, Stephanie. Next one. This chart, just look at the right column. This is our 10-year performance of the traditional, the non-alternative investments and the alternative investments, and it shows the volatility of these investments. So in the middle where it says alternative, you can see we had a 12.4% return, average annualized for 10 years with a 6% volatility. It's how much it moves around month to month. On the traditional portfolio, we earned less, 8.1%, which is still a good return, but its volatility was almost double the alternative. It was about 11.2%. And you combine those together, you get the total return from the LTIP 10 years of 10.5%, and our volatility is 6.6%, almost entirely driven by that, by the alternative program. And if you look at the bottom, you can see the benchmark was 8.6% and had a very volatile return profile of 11.1%. All right, Stephanie. When you put this all together in dollars, when I arrived in 2000, we had a $1.2 billion endowment. We've had, during the campaign and after the campaign and through other sources, we've had $538 million of gifts come into the endowment. There have been transfers in of $426 million. That's partly from our foundations and affiliates that support the university or are under our umbrella. Also, it represents money that our Board of Trustees has designated as endowment. So if a donor passes away, typically it makes a bequest to the university, but it's not designated as endowment. The university trustees typically put that in as endowment. So that is a transfer. The benchmark, if you had invested passively, you would have earned $915 million. We have all of this in a model that shows what it would be. The active management, so this is the outperformance from the firms that we've hired, as well as the allocation decisions from the investment committee and this office, added another almost 2.5 billion on top of the 915 million. So the total return is about 3.3 billion and change over the 21 years. We've spent 1.8 billion on faculty salaries and scholarships and other support of the university. And then it gives us the ending value of the fiscal year at 3.7 billion. Next slide, Stephanie. This is how the endowment is allocated, mostly medical center, college, and other. When you look at those two on the top, that's the undergraduate program. Most of the other category is money that's come in, as I described, from donors that wasn't designated as endowment. The board said we want this to be endowment, and most of that goes for undergraduate education and faculty salaries. The art gallery, obviously, important part of our community. Their endowment is managed by the university. Warner School, Eastman, and William Simon School make up the balance. Next one, Stephanie. We measure our gifts and spending from the endowment against the close peers, the 9 schools that I mentioned, as well as the Ivy Leagues and other large endowments to see how we stack up. The gift number for Rochester on average for the past 5 years has been about 1% per year. That is a very good number. It's growing every year. Our close peers, that 1.7% is affected by some of the multi-billion-dollar and multi-billion-dollar gifts that have come into just a couple of institutions, Johns Hopkins and Bloomberg's gift. You might remember that one. We haven't had those gifts at the University of Rochester. We're kind of a brick-by-brick place, building the endowment fund by fund. When you look at the Ivies included, their gifts are very close to us. They have larger endowments, and they're actually getting less as a percentage to their endowments compared to Rochester. Our spend rate is essentially even, 5% per year, average the last 5 years to the close peers in the larger group. Okay. Endowment growth is a function of performance, investment performance, which is what we do, plus that giving less the spending. And when we look at our endowment growth for the past decade, we've essentially doubled it. And the median is about 120%, pretty close to ours. And the mean is 129%. Again, influenced by the billion-dollar gifts to certain peers. The trend is what I focus on, what I think we're all focusing on. As long as our endowment gifts continue to grow, I think we're doing a good job with our advancement program. And I want to thank all the donors that are on this call today for their support. And they should know that we're being prudent in the spending. When I arrived here, the spending rate was 7.2% per year, which was unsustainable. So we've really done a great job through performance and giving and budgetary control to get that spend rate where it should be. Okay, is that the last slide? Oh, that's just a cumulative, how you get to the 1.8 billion. Year by year, that's the spend rate on the blue lines. You can see that we had a little leveling off after the global financial crisis when endowment performance was a little less than it's been in the past decade. That's normal. All right, Stephanie. So thank you. And we have lots of time for questions here. I don't like to drone on with my comments. We did get 11 questions sent in by email in advance. And Stephanie is prepared to ask those of me, but we also have time for people to ask questions in the chat or by email. You can also send us a question at any time through the website. It's invest.inquiry@rochester.edu, and we'll be happy to answer your questions. So Stephanie, do you want to start with the first question?
Absolutely, Doug. What are priorities for endowment funds?
Yeah, the priority has been for the past 2 decades to increase the support we provide to our faculty and also increase the financial aid availability for students. That gives us the ability to be more flexible as an institution. We have can be less reliant on tuition. And it also allows us to improve the margin of excellence that we have as a private research university. And all of our peers are following the same approach, which is to get us into a more sustainable position through good financial management, and endowment's a big part of that. So we've done remarkable work on that. So that's a priority, is continuing that.
Great. The next question is, what are the investment strategies employed by the university?
Yeah, our website gives a lot of information on this, but in summary, our job is to be a manager of managers. So we hire investment firms around the world that have unique capabilities that we think are repeatable. And we also want to be sure that those managers are not replicating what other managers are doing in the portfolio, so that we truly get a diverse stream of performance, and that performance also will exceed the passive benchmark. Because if we're doing all this and we're not earning a margin of return, there's no sense for the office to be in existence. So the strategy, again, is to hire really top firms that are diverse across the spectrum of managers. We also, obviously, the strategy, we want to outperform the average of our peer endowments.
So how do these investment strategies differ from some of our peer institutions?
Yeah, look, we're all trying to do the same thing. And I know a lot of our peers, their allocations are fairly similar to ours. I think the one difference we have is we make more gradual allocation changes, and we take probably a longer approach, longer view. In my 22 years here, we've actually changed the program very little. The allocations have moved a little bit, but the benchmark has always been 80-20. The correlation has always been fairly light at something like 60% of the benchmark. And I think that some peers maybe push a little too hard on trying to get top performance. They want to be number one or number two. We're actually pretty happy to just be in the upper half. And I think it allows us some latitude to take our time. And when an endowment has relatively poor performance, they change things, and sometimes those changes don't always work. So staying with the program, making gradual changes, taking a long view. That's our approach.
Thanks, Doug. The next question is, how are you managing in a world dealing with such destabilizing issues, including raging inflation, supply chain limits, gas and oil restrictions, and political upheaval on a global basis and within the US? What is the strength of the portfolio with all of the market turmoil we are seeing, and how does the university weather the correction?
Yeah, I mentioned this in the comments a few minutes ago, that we have a low correlation to public stocks, and public stocks seem to get the brunt of these changes in our economy and our world through the volatility we've seen in the past 5 years. We know these things happen. And in the video that is on our website, which I hope you all have a chance to look at, I mentioned that I have a chart on the office wall that has 100 years of market performance and different events in society and in the world that cause volatility. And when you look at that, there are literally dozens and dozens of things. And the worst things are wars, and pandemics are really bad too. But when you look at that history, you realize there's a great benefit to diversification, and there's a great benefit to active management as well. So in today's environment, this is really one of the most amazing environments I've ever seen. And I don't mean to sound overly optimistic, but the opportunity set for active managers is wider now than any time I've been at Rochester, probably any time in my 40 years, because we've had a shifting of policies that favored growth in equities, pricing, to one that's going to be more restrictive and is clearly showing its impact on the world. We've had some lessons learned in the pandemic. We've had some global challenges in China and what's happening in Ukraine, the horrific activities by the Russians. So these are all just creating this turmoil, and good managers are out there finding opportunities, as are we, by the way. It's a good question. Thank you.
Has the portfolio been divested of Russian assets?
We have about less than 0.5% in not direct Russian securities that we've made investments in, but these are partnerships that own things, for example, maybe some apartment buildings or illiquid security in Russia. So very, very small exposure. We have no direct Russian managers. We've never hired a Russian manager. And there was a question that came in a month or so ago, is there something that we're doing that somehow supports the Russian military? And we have nothing like that in the portfolio. So it's about 0.4%. So 0.4% of the portfolio has some Russian links, and we can't sell those positions because they're illiquid. Some of them have already had some pretty sizable write-downs. We also have some investments in Ukraine that have had an impact from the agricultural problems that have been inflicted by the Russians. Those are about 1/3%. So we're watching those closely, but again, nothing material here to the portfolio in Russia or Ukraine.
Thanks, Doug. The next question is, what is the withdrawal rate in current market conditions?
Yeah, we've had a consistent spending policy here. We have a new policy that's going to our Board of Trustees in June, which we expect them to approve, that will have an inflationary component. Our spending rate has always been determined on a 5-year rolling average of the endowment market value, which is fine, but in volatile times, it can move the spending around in ways that we wouldn't want it to move around. So adding the inflation component to the spending will help assure that we can continue the support of the university, even in volatile times. And some of the best endowments in the country, large Ivy universities, have a component in the spending formula. So our spending rate at about 5% per year, we expect to be able to continue.
Thank you. Would you please discuss any impact that ethical considerations have had on recent investment choices or activities?
Some participants may know that there's an ethical investment advisory committee at the university that has faculty, staff, alumni, and students on that. And they listen for any concerns that the campus may have, and they evaluate those concerns. They write carefully researched papers on them, and they're sent through this office to the investment committee with any recommendations. In the past few years, there have been recommendations that were approved on no new fossil fuel investments from the office. So we don't invest in oil and gas, petroleum anymore. There was another one on private prisons. We don't have private prison exposure, but we can't invest in private prisons. There is a slippery slope on all of this, that if there are too many sectors or areas where we can't invest, we narrow the opportunity set. So this is all carefully balanced by the investment committee. But the Ethical Investment Advisory Committee has been helpful, and we consider them a partner in our work, because they do represent the community that donates to the endowment, and also the community that we support.
Great. The next question is, how many endowed funds are in the pool, and specifically how many scholarships?
Well, I'm glad the question came in advance, because I wasn't quite sure what the answer would be. We have 2,780 individual funds. And if we add in the affiliate funds, if our affiliated hospitals and other entities that have come into the pool, there's a little over 2,800. There was a second question related to this: how many of those are scholarships? And it's 1,287 are scholarships. So roughly half of the endowment is in scholarships. The one thing I want to point out is the scholarship value is not as large as we would like it to be, and it's not as large as other endowments. So we would like to have more scholarships to support our really fantastic students. So that's an area of emphasis going forward, is to raise more scholarship money for the university.
Thank you. Regarding the asset allocation, how do we view the overall commercial real estate sector?
Yeah, commercial real estate is part of our program. It is not a category that we've made direct investments. So we don't own commercial property in Rochester or residential property, for example. We do have partnerships where we're a limited partner at the university in a fund where the partnerships may invest in commercial real estate, not just in the US, but around the globe. So we have investments in Asia, Europe, and we also have, if you consider farmland a commercial investment, we have a Ukrainian farmland and some other farmland. But we hire managers to make those decisions for us.
Next question is, can you talk about the IRS private letter ruling for trusts and what that means?
Yeah, I know this question came in from our plan giving people because they like this a great deal. It's been more than 10 years since we've had this ruling, and I'll explain what it was. The Harvard University decided that they would like to invest their trust. These are trusts where people contribute money and then they're paid an income for the rest of their lives. And then when the trust terminates upon their death, the money becomes endowment for the school. So Harvard had the idea that if they could invest those trusts alongside their endowment, the returns would be better and it would lead to more donations. And in fact, they were correct. We learned of this very early after Harvard received the permission from the IRS to do this, because normally you can't commingle trust money with endowment money. So they had to get a ruling from the IRS. They were successful in that ruling. We were the second university in the country to obtain that ruling. And it has been really quite popular with our donors. And the question is, what would the returns look like? So if we've earned about 10% a year for the past 10 years. If it's a 5% payout, the 5% would grow by roughly 5% per year. So I don't have the exact math in front of me, but that's so a 5% yield plus 5% growth. That's what we've achieved. And it would be a little bumpier than 5% even, but that's essentially how these programs work.
Thank you. What are the investment office's plans for the future, and what is the office's future outlook for the endowment?
Yeah, well, once the travel restrictions were lifted, we started traveling to see firms around the world, not everywhere, but we can't get back to China. But we've been in London, and just this past week we're in New York, taking other trips. So we sit with some of the best investment firms in the world and listen to what they have to say, and then we come back and look at our research and make decisions for the portfolio. So these in-person meetings are extremely valuable, and there really is no substitute for them, even with Zoom. I said this before, but the opportunity set has widened as a result of all the turmoil in the world. It's our view that the passive benchmark, that indexing that I mentioned, the 80-20, 80% stocks, that return will probably be lower and more volatile going forward. It's been a really robust time for the past two or more decades for stocks and for passive investing. We think the margin of outperformance for active management will be significantly higher than it's been for us in the past 20 years. We earned about 2.3% net of all the fees per year, better than the benchmark. If the benchmark is slower, lower, I think we'll earn a very large margin. No guarantee on that, but this looks like a very good opportunity set for active management.
Great. What is included in the natural resources asset class?
Yeah, natural resources are the legacy oil and gas, some production and some storage, upstream, downstream activities. We have some farmland, I mentioned that. There may be some other small holdings in there, but predominantly it's energy. And there's also alternative energy in there, I should say, green energy.
Thanks, Doug. The next question is, with analysts and the SEC raising questions about private equity fees and return metrics, how confident are you that your outlier returns are in fact reliable?
Yeah, this is the disclosures of fees is what the SEC is after. And, net of all the fees, for those that don't know how this works, the partnerships we enter into buy companies, essentially, some of them are older companies that they're fixing, and some are newer companies that are venture capital based. But once they start returning money to us, and they've given us all of our money back, they earn 20% or more of the profits above that level. And they also charge a fee along the way, which might be 1 or 2%. And that's basically turn the lights on to pay salaries while they're going about managing these companies. We have earned really pretty extraordinary returns above the public stock benchmark. And we disclose all of that to our investment committee in our annual report. But what are my thoughts about disclosing this? I've always thought private partnerships were private. And I think that's really the public pension plans and others that are investing in this area maybe have not earned the margins that we have. They're pushing for this. I just don't see it as something that would affect us in any way. Our managers could disclose their numbers. I don't think it would affect their businesses or our returns. Good question, though.
The next question is, how much of the endowment is restricted in its use rather than by its particular school?
Yeah, so if you aggregate the endowment, so thinking of the 3.7 billion, we really have to take off the 20% of that is not endowment money. That's the trusts and the affiliates and the foundations that support the university. So the real endowment figure is it's about 80% of the 3.7 billion. Of that 80%, more than half has no restriction from donors. So in other words, it was not given to the university as an endowed fund. It was either bequeathed upon someone's death, and then the trustees designated it as endowment. And by the way, that includes George Eastman's gift, which is a big part of the unrestricted endowment. The trustees designated his entire estate as endowment. So we have an unusually high percentage of endowment that's from the unrestricted side versus the restricted side.
Thanks, Doug. How much investing in Rochester area businesses is there within the endowment?
We don't have a carve out for local businesses. Everything has to stand on the merits. It's got to be something that meets the return thresholds and diversifier thresholds. We also don't have a carve out for alumni businesses. So everything we do is completely agnostic as to geography, as to relationships with alumni or friends. It's all done on the level on the merits. So we do have actually pretty recently we made an investment with a money manager that's in Rochester who has an enterprise that's actually not in Rochester, but it's a Rochester-based firm. It's one of the first ones we've ever made, but it rose to the top based on the merits.
The next question is, which of the fund managers that you utilize have been the most productive over the past years?
Well, there's one in particular. We don't disclose the names of the firms. I can describe it to you. It's a venture capital firm, and it's been driving our results, or really enhancing our results probably for the past 10 years. But they have firms, companies that are created very early. Some are middle life, some are late in their life. In China, India, United States, a little bit in Israel. And they just have a knack for identifying companies that can get very large and can sustain themselves once they're large and are profitable. And then they're very good about exiting these companies too. So they've been just an enormous benefit to us. It's also our largest allocation. So it's been a great benefit having that relationship. And it's widely recognized as a firm, top firm by our peer institutions.
Thanks, Doug. What percentage of an endowment fund is used annually to run the fund, not counting the cost incurred by funds being used?
Another good question. I bet that came from an investment committee member. So this is the internal costs, the staff of the office, including our travel, and we have an office in Pittsburgh that is owned by the university, so we pay rent for that. All of that put together is 0.8% per year, so less than 1% of the endowment is used to cover all of the costs. That's all the staff of the office and travel, as I said, and paper and public things we publish for the committee. And that actually benchmarks very well against peers. I think their average is about 1.5%. So we're almost somewhat around half of what peers are paying.
Thank you. Doug, what is the succession planning process for you?
It's confidential. It's between the president, the board, and me. There is a process. I can tell you that. I have no plans on leaving your term, but all the officers of the university have a succession plan. And mine is not in months; it's in years. All right, so I'm here for a while.
Great. We touched on this a bit earlier, but given the current economic environment, how are you responding to the prospect of a recession?
Yeah, recession is it's an economic period where there's tightness and there's problems in employment, and we can have inflation with recessions. I think it's more of a problem for the university itself. In terms of if it's an inflationary recession, that our cost of goods and services could rise at a time when we can't increase our revenue. That's been considered in the budget development for the university. Recessions, if they correlate to stock market declines, which typically they do, our portfolio is not immune from declines, but it is less correlated. So we should hold up relatively well. No guarantee that we won't lose money. We've had a few small loss years since I've been here, but the losses should be much less than the passive benchmark.
And a related question, unique would appear to be the possibility of inflation plus recession plus bear market. How does that affect forecast?
Yeah, so those triple threats definitely impact the return environment for public stocks, and you've seen this just this past week in some of the retail stocks that have been clobbered. And again, when I showed the pie chart that showed we have 31% in public equities. It's the other 69%, or 62% alternatives that is most impactful on our performance. And those managers, including hedge fund managers, have much more flexibility and much more protective characteristics than you would find in the public part of our portfolio. So we've already built this portfolio to endure these periods. Again, no guarantee that we'll make money, but again, our losses should be less than the benchmark.
Thanks, Doug. How illiquid are the private equity and hedge funds? In the event of a 2007 through 2009 type meltdown, how do you assess the need to fund the cash needs of the university? How did the university deal with the cash needs during the pandemic?
These have got to be insider questions. Somebody. So we have a very extensive liquidity management program, and I know Rich is on the call. I wouldn't be surprised if he prompted the question, Rich and Sulaco. But we've never had a liquidity squeeze here. That's the first thing you should know. That the squeeze is if you are investing in these partnerships, and typically they have 10-year lives, and when they early on, you can't get your money back and there's no distributions from them. So you really have to put these all together in a plan and make sure that the plan is going to fit with the university's liquidity profile. So that's what we do here. We have several models that we employ. Our program, the liquidity today is actually quite good. We have flexibility to move things around. Our commitments to these partnerships is the lowest level since it was low when I arrived. We ramped it up, but today it's much lower than it was during the global financial crisis. For example, during the crisis, we had well over 20% of the program was committed to these partnerships, and we were a little concerned that that we might get tight on funding, and that didn't happen. That same number today is 6%. So it's a much more liquid portfolio today than it was during the financial crisis, and we got through the crisis just fine. Good question.
Thanks, Doug. Next question is, how long does it take to change allocation of funds when a better opportunity presents itself or a negative impact of an investment develops?
Yeah, that question is not easily answered because there are many constraints on our ability. We have contracts with managers. Sometimes we can ask for an exit before the contract is up, or we can sell something to another investor if we really want to change it. So the question was how long? And it really has many, many answers to it. You have to look at each investment and look at the opportunities that we're moving into. There are many things in the portfolio that are liquid, monthly, or some of them are daily liquidity. And if we wanted to change those are very easy to change. And there is a big part that's intermediate lockups, and we can change those typically quarterly or semi-annually or annually. The longest locked up money is in the private partnerships, and that's about 38% in total. But of that money, a good part of it is already through its 10-year life, and it's just in the distribution phase. So it's a complicated answer to a complicated question.
Thanks, Doug. Next question is, can you compare the cumulative contribution of the college to support the advancement office over the past 20 years with the endowment spending allocated to the college over that period? What would the ROI on that contribution look like?
I don't have those numbers. This is a question that's being asked at, ad hoc here. I can tell you this about fundraising. I mentioned our office cost is about 0.9%, and we've earned 2.3% above the benchmark. So I think that's a good multiple, if you will. So we earn 3 times, 2.5, 3 times the cost. In fundraising, I was involved with advancement here for a few years early in my career. I learned that you really have to invest money to have good fundraisers, alumni relations, and events, and all these things that bring people closer to the university in order to engage them philanthropically. It's just an essential function. What that number should be, when I was starting here, they were looking at numbers saying, well, we should spend 8% or 10%. I think it's actually worth spending more than that. It seems like the more you spend, the better you do, and there's always a margin above the cost of philanthropic support, the expenses of it. So I don't know the number, but it's a return on investment that it's a very good return on investment. All the investment money we spend.
Thanks, Doug. Can you provide any examples of how the non-equity positions are insulated from the declining valuations that the publicly traded positions are affected?
Yeah, so the non-equity positions are, some of those are in the hedge fund program, and some of those are in our fixed income program. So the fixed income program is relatively small. It's 4 or 5%. It is in a category we call the unconstrained manager category, but its duration, if you think about bonds that have maturities going 1, 3, 5, 8, 10, 20, 30 years, these are all on the shorter duration, and they have characteristics that keep them less correlated to bonds. So that's an important part of it. The hedge fund program, there's credit activity in there, so that's protected through hedging activities. And the hedging itself on equities is also a way of generating return net of the longs. So when you look at risk, it's a de-risking category. But putting it all together, it's multiple things that create the category. In a normal environment, which maybe we are moving back to a normal fixed income environment, we would have 20% in bonds. We haven't had a normal bond environment in almost 20 years, where there's a yield curve and spreads and everything sort of makes sense. We've had this amazing stimulus going on, and we've had the dropping rates, declining rates. So we've hit an inflection point, and so we might have a higher bond allocation going forward.
Thanks, Doug. That concludes our attendee questions. So Doug, I'll turn it back over to you for any closing comments.
Well, we're ahead of schedule, and that's always a good thing. So we can give you some time back. I really just want to thank people. We had 140 so participants on here. I looked at the attendee list. We've got alumni and parents and trustees and donors, doctors and patients, I assume, and some of our leaders from the faculty. Really, just want to thank everyone for taking the time and learning about the endowment. I will say it's been a pleasure to see the results of the work we do here manifest on the campus in terms of the aid for the students and the support for the salaries of our faculty. And we want to do more of it. It is the margin of excellence for the University of Rochester. And our motto says it well, Meliora, ever better. Is there another question that popped up, Stephanie?
So Rob asked anything about diversity?
Oh, that's a setup question.
Right.
I think that you should talk about what you and Rob talk about what you do, Stephanie, on diversity, the IADEI, just briefly.
Yeah, sure, absolutely. Happy to do that. The investment office continues to work toward its 3 broad DEI initiatives that the investment committee approved in October 2020. The first is to survey the LTIPS managers on their own team demographics and internal DEI related policies and practices. We just recently completed our 2nd round of those questionnaires, and overall, we're pleased with the efforts that the LTIPS managers are making with respect to DEI. What we're looking for is improvement over time at the individual firm level. The office's 2nd DEI initiative is to identify new woman and minority-led prospects for potential investment, and then sharing these ideas with institutional peers. And to be clear, this is something that has always been done as part of the office's process, but has been expanded over the last couple of years. As many of you know, in 2020, our office, along with one other institution, founded the group Institutional Allocators for Diversity, Equity, and Inclusion, or IADEI. This organization now has over 530 individual members from more than 300 institutions. Significant areas of focus include directing capital toward diverse fund managers, enhancing the efforts of other nonprofits with similar goals, engaging with influential market participants, and facilitating access to research related to DEI in asset management. And if you'd like to learn more, please visit iadei.org. And then the investment office's 3rd DEI initiative is to improve opportunities for women and minorities in the professional pipeline. The investment office is a department of the University of Rochester, and we intend for our DEI efforts to reach the larger university community. And one way that we can do that is to promote careers in investing to underrepresented student and alumni groups here at the U of R. In particular, the investment team is currently in process of bringing on a student intern for the summer, and special efforts were made to attract diverse candidates for that position. So thank you for your interest in this topic and for your questions. We look forward to continuing to provide updates. And then I believe there is one additional question that has come into the queue. Is there any investment in Series 1 savings bonds?
I'm trying to remember if Series 1 is only available to individuals. It's kind of like the I bonds where you have to go Treasury Direct. There's a limited amount, and I do not believe that we can invest in those. We have from time to time a related question had laddered treasuries in the portfolio. We may do that again, but that is not a strategy that we pursue.
Thanks, Doug. That concludes our webinar. Thank you again, everyone, for coming, and we'll see you again next year.